The world of cryptocurrency is bursting with opportunities. Beyond the excitement of trading, a whole new avenue emerges: passive income. Imagine earning rewards simply by holding your crypto assets. This is the promise of staking and yield farming, two popular strategies that have taken the crypto world by storm. While both offer the potential for attractive returns, they come with their own set of risks and rewards. Understanding the intricacies of each is crucial for any investor looking to navigate the exciting yet complex world of decentralized finance. In this evolving landscape, it's essential to approach these strategies with a balanced perspective. Let's delve into the details of staking and yield farming, exploring their mechanics, benefits, and drawbacks. By the end, you'll have a clearer understanding of which approach aligns best with your investment goals and risk tolerance. Remember, in the world of crypto, knowledge is your most valuable asset. Staking is a straightforward path to passive income in the crypto world. It involves holding your crypto assets in a wallet to support a blockchain network. Think of it as depositing money in a bank account. When you stake your crypto, you contribute to the blockchain's security. Certain blockchains use proof of stake to validate transactions. If you act honestly, you'll be rewarded with newly minted coins, support the blockchain, and earn passive income. Yield farming, also known as liquidity mining, takes a more adventurous approach to generating passive income. While staking involves holding your assets, yield farming requires you to actively participate in decentralized finance, or DeFi protocols. These protocols rely on liquidity pools, which are essentially smart contracts that hold a large pool of crypto assets. These pools facilitate lending, borrowing, and trading activities within the DeFi ecosystem. As a yield farmer, you provide liquidity to these pools by lending your crypto assets. Borrowers can then access these funds, paying interest for the privilege. The interest earned is then distributed among the liquidity providers, or yield farmers, proportional to their contribution to the pool. This is where the farming analogy comes in. You're essentially seeding the DeFi ecosystem with your assets and harvesting the rewards in the form of interest or fees. Both staking and yield farming offer enticing opportunities for passive income, but they come with their own sets of advantages and disadvantages. Staking is easy to understand and suitable for beginners, offering predictable rewards and stability. It's generally safer, as assets are held in secure wallets. However, staking returns are usually lower and require locking up assets. Yield farming can generate higher returns, especially during high demand for liquidity. It offers a range of DeFi protocols and liquidity pools to tailor your strategy. But it can be complex and requires understanding DeFi protocols and smart contracts. DeFi protocols are susceptible to bugs and vulnerabilities, putting your funds at risk. The choice between staking and yield farming ultimately depends on your individual investment goals, risk tolerance, and knowledge of the crypto space. For investors seeking a more passive and lower-risk approach, staking offers a relatively safe and straightforward way to earn rewards on their crypto holdings. It's particularly suitable for long-term holders who believe in the underlying technology and are comfortable with the potential for lower returns. For those with a higher risk appetite and a deeper understanding of DeFi protocols, yield farming presents an opportunity to generate significant returns. However, it's crucial to thoroughly research and understand the risks involved, including impermanent loss and smart contract vulnerabilities. As the crypto ecosystem continues to evolve, we can expect to see further innovation and diversification in passive income opportunities. Staking and yield farming are just the tip of the iceberg. New protocols and platforms are constantly emerging, offering unique ways to earn rewards on your digital assets. From lending and borrowing platforms to prediction markets and decentralized exchanges, the possibilities are vast and constantly expanding. The key to success in this rapidly changing landscape is to stay informed, diversify your investments, and never invest more than you can afford to lose. As the world moves towards a more decentralized future, understanding and leveraging the power of passive income in the crypto space will become increasingly important for individuals seeking financial freedom and control over their assets.